Alright guys, what's going on? This is Ryan, also known as Cantering Clark on Twitter. And before I get into anything, I just want to wish everybody a happy holiday, whether you celebrate Christmas, Kwanzaa, Hanukkah. Doesn't really matter to me, but the holidays are an important time of the year. It really puts things in perspective, reminds us what's important in life. It's an interruption into the distraction I think that many of us can fall into, or a state of distraction. Where we're so, head into our work that we forget what's really important in life. So, happy holidays to everybody. And in this video, I just want to briefly cover what we've seen over the last few days, certain anomalous behavior that we've seen transpire, and I want to talk about why I was dead set on, after being stopped out of my first short, on still maintaining my short or bearish bias. Even in the face of a really flippant emotional state of most that can be found on crypto Twitter, a slight change in price behavior will cause people to immediately flip their bias, and I think lose the bigger picture. And then in regards to the anomalous price behavior we saw, there was a lot of focus on one particular buyer or seller, whether it was the same person, I think 10 million buys and then 10 million sells. And this type of stuff it's just a distraction, okay? There's the assumption that, if this person is a whale, that clearly they have a better idea of where price is going than I do. So, I might as well start paying more attention to this than to maybe some of the larger, more useful pieces of data or evidence rather. And like I said, you could lose sight of the bigger picture. So what I'm always trying to do as a trader, my entire trading career, is I've always tried to be on the right side of the market, right? Not on the crowded side. I'm trying to make sure that I have a good idea of what the larger market picture looks like. And then I want to be able to spot who the aggressor is and whether or not they're doing a good job of getting price to whatever point they intend on getting it to. And when I see that there is a clear aggressor, and price is not moving in their intended direction, rather in the direction that they're aggressively either buying or selling in, that's when I could really start to choose a side of the market, when I see that someone's efforts are really being subdued. And more often than not, what I see after this is that, as predicted, when the aggressor cannot move price, right, the stronger, heavier hand is in the opposing force, right, that's absorbing all that pressure, whether it's buying or selling pressure. So, as always, I think the most important thing to do is to take a higher time frame view. And I'm not talking about the secular view that many get caught up into, which is just the logarithmic look of the chart, which is clearly an uptrend forever. But right now, okay, I think the most important trend is an immediate trend, right? It's a higher time frame trend. It's the trend from November of last year until where we are currently, but with a focus on this area right here, because market structure has changed, right? From the period where we spent 3 months up here to where we lost that range, to where we retested and then had this sell-off right here, and to where we currently are. All right, so looking on the weekly chart, just to map out some simple areas first. Okay, again, I'm most focused on where the volume took place, but market structure is something that you can map out with wicks and combination of candle closes. And then I'll map out specific areas based on high volume nodes within those areas. So based on, these two weekly closes and opens, all right, and then the low of this structure, of this low right here, okay, this swing low, the low of that structure indicated by that wick, all right, I'm not going to count this deviation below that range, all right, not much volume was transacted down here. And the volume that was transacted was right beneath this wick right here either way. All right, so it's close enough for me. So going down to the 4 hour, okay, first I'll mark off the swing low. All right, so we have two key areas, this swing low, all right, the low of that structure based on the wick, okay, most of the volume taking place between this area, and then the swing low here, and if we consider the swing low of this wick, there's a good amount of volume transacted down there as well. So I'm interested in identifying where there was a good amount of Bitcoin transacted, where buyers and sellers are most interested. So this pretty much encapsulates the majority of the range that we've been within, okay? And you'll see there's a lot of focus lately on something like the monthly open or weekly opens. And in traditional markets, this made a lot of sense, right? Because if you're a larger trader and you're trying to put on a position over time, putting a position on good till cancel on something like the monthly open, weekly open, quarterly open, there's a high probability that price would revisit that area multiple times and that you would likely get filled, whether it was to the short side or to the long side. So on the Cantering Clark indicator, I have a few of these things built in, and we'll put one of them on and it'll show the monthly open. And the monthly open was a reasonably resistant area, okay, for most of this structure from the beginning of December, okay, up until where we currently are. And this is not so much because we can imagine that one trader is maybe filling a position in this area, other than, or rather that it is just like most TA that we see, it is a self-fulfilling prophecy, because this becomes something that's practiced often by many other traders and adopted, and therefore it grows in its value in terms of its level of effectiveness. So what we saw was that this was an important area, all right, with this swing upward. Again, coming into this area, we would have to approach this area with the same level of caution. So, you'll see a lot of price action traders and traders who are mapping out the structure, map it out in different ways. Pretty much you're going to imagine that the swing low, whether you're doing by wick or by close, okay, that's up to you, right? Up to your system. You'll see that the EQ is predominantly going to be found within this area. But again, what do? I'm looking at the volume, right? So I want to see from the swing low to the swing high of the structure, all right, how the volume has changed over time. And you can see that this was the point of control in the beginning. All right, as this evolved moving forward, point of control rose a little bit, all right, became more in line with what is considered by many the EQ, all right, dropping further from there, staying actually maintaining, okay, up until where we currently are, all right, it dropped. But what you'll see is where we currently are when we have this whole area enclosed within this volume profile, you'll see that the larger nodes within here still correspond to the areas that were really important early on. So we'll typically see that an area where there was a large amount transacted, where buyers and sellers were very interested, is going to maintain a level of importance moving forward. So if we're just going to delineate those areas, okay, marking this, all right, I'll change the color of this these lines just so it's a little bit more obvious. Okay, here, all right, and then the high. All right, so now we have these red lines indicating how the structure has evolved. And again, this can be a little noisy, depending on your preferences. You might want to take away some of these as price is moving across. But again, what you can see, that these pretty much cover where we found most of our interaction. What I advise is that as price is moving forward on the lower time frame, you begin to evolve this, and when things have become less relevant, right, you let them find their way out of the picture that you're framing. But regardless, all right, what we'll see is these areas have remained pretty true, all right, and the two areas that I say have stayed true, and rather the whole value area moving forward has stayed pretty much the same in terms of most of the volume taking place between here, okay, around 75, 50, all the way down to around 70, 100. All right, so the value area being in the center of this, you can imagine that this is pretty much fair value. So if we're just talking about auction market theory, when price is coming above this area, or when price is outside of value, when it is above value, what we'll typically see is price auction back down to fair value. And when price is below value, all right, what we'll likely see is when it approaches the low value area, it'll typically auction back upward towards fair value, which would be the point of control or somewhere within the middle. Okay, somewhere that probably is going to be constantly evolving, like I said, depending on how long the range is painting. But either way, what we'll see is these areas are respected, and it's just basic auction market theory. If you think about, the asset being an auction or within an auction, just imagine if you are in an auction house. Let's say we're auctioning cattle, right? The price of cattle gets to a certain point, it rises up, right? There's a lot of volume. Maybe the room is loud, it's shouting, it's auctioning upward, and then it reaches a point in which the room quiets down a little bit. Maybe there's not many buyers interested in this area. Price will auction back down until it finds new buyers again. So we'll see it spend a good amount of time within this fair value area. And pretty much, I wouldn't say that this trade should be just taken on this alone, but when a price approaches the high of a value area or the low of a value area, when it's within a strict range, what we'll typically see is that this is a good counter trade to take, right? Counter trend trade to take, right? So as I mentioned before, the middle of the range is somewhere that I try to stay away from, right? Just because the risk return of it, in my opinion, is not as great as taking trades that are at the exteriors of the range. And that's just because I trade. I'm basically adopting a little bit of what is found in market profile, auction market theory, and applying order flow metrics to this, or order flow analysis to this rather. So order flow is not a trading system. Okay, it's just it's a decision support tool. Put it that way. It's just a decision support tool. I'm just looking at the data in regards to what is taking place at the atomized level between buyers and sellers, specifically how much Bitcoin is transacted, how much volume is taking place, right? Aggressive buying versus aggressive selling. Excuse me, my phone is going off. So what I was looking for, what really piqued my attention again, was even though, regardless of the fact that many became immediately bullish when we came off these lows, right? You know, it's expected that within this market, people are overly emotional. What I was starting to pay attention to was, again, it comes down to delta, right? So what is the intention of the aggressor, and are they doing a good job of getting price to move according to their intentions, or rather intentions, excuse me. So put it this way, all right? When I'm looking at delta, okay, what I am looking at is the amount of effort that's applied to the market, all right? How hard are they pushing? And for the amount that they're pushing, how much is price moving? Okay, so if you just take it in terms of this simple analogy, right? So the buyers are pushing harder here, okay? Or rather pushing harder here, all right? Harder than they pushed over here, just to break this down in most simplistic terms, right? But over here, when they're pushing harder, the range, or the high-low of this area. So if you measured it, you know, by individual 4-hour candlestick, if you measured it by daily, what we're looking at is the high and low range of the candles that have the higher delta. What you'll see is that there is less distance that was covered. All right. So what this says is that there's more effort that is being applied, all right, by buyers. Okay, but there is less to show for it in terms of distance traveled. All right. So over here, what we're looking at is these delta bars over here. So what you have is the cumulative volume delta, so the running total of delta as it's changing. Green is the aggressive buyers, all right, so buyers that are lifting the offer or taking liquidity aggressively, so they're buying at market. All right, red is the negative delta, so those are sellers that are hitting the bid, so sellers that are executing at market. On the other side of these orders is always a limit order, right? So the advertisement is the limit. The person pulling it off the shelf is the aggressor. So aggressors over here, all right, but the aggressors over here were more aggressive, but they were less successful in getting price to move the same amount of distance as we had over here. All right, so what that says to me is that there is a larger entity on the other side of this, because remember, there's always a buyer for every seller, and there's always a seller for every buyer. One is passive and one is aggressive, right? So we have higher readings in delta, and if you are not using XO, right, this is a running cum. If you go into Tensor, all right, if I'm looking at a 4-hour, what I'll do is I'll put my CVD onto a 240 setting. And then you'll see that because this period setting is a little bit different at this point, it's a little bit sharper. And you could look at this structure now and you could see, okay, over here, we are not yet over these highs, but the delta is much higher. Okay, buyers are much more aggressive over here, but for all the work that they're putting in, they're unable to move price nearly as much. Okay, so someone is on the other side of this, and that's all I need to know. I don't care how bullish people are. I don't care about some buyer who is buying 10 million or selling 10 million. It doesn't matter to me at that point because I don't need any of that story. All right, I've identified at this point that someone is not letting price move. All right, and if they're strong enough to hold price at this level, okay, that to me, added with the fact that on the higher time frame, you know, if we just look at this weekly, for example, all right. And I understand that now maybe these are pretty mixed in terms of it might be difficult to identify what's what when they're all the same color, but I'll just mark off the weekly low of the candle and the wick. And now we'll see that this area was an area that we could expect would be an area that would serve as major, you know, a major area to contend with, all right? These highs, all right? In this structure over here, and excuse me if I say I'll write a lot, right? This structure over here, we had much more aggressive buyers, okay? We had more aggressive buying over here, okay, but less movement in terms of price, All right, so it was taking more to rotate price throughout this range all the way up to the top again for this rotation versus this rotation. So what that says to me is that market structure is still intact, all right, and someone who is a higher time frame participant, so someone who does not worry about what takes place within these trenches and is only worried about the higher time frames, is acting, and they're able to move the market at their will, essentially, right? And I'm not talking about one particular market entity. I'm just talking about the fact that this is the brick wall at this point. So put it that way. That's the brick wall, all right? And the smaller hands, the smaller participants that are executing at market and are aggressively taking liquidity, they're not going to overtake that entity, all right? They're not going to overtake the heavier hand that's in the limit order, all right? And you'll see a lot of times there'll be iceberg orders, and this is all things that are the most important pieces of information, I believe, to pay attention to. So you have all these things add up. You had the monthly open, all right, again, approaching that area again. You had the major structural zone that we were approaching again. All of this didn't matter to me at this point. Okay, this didn't matter to me at this point. All that I cared about was the fact that buyers were more aggressive over here, but their efforts were in vain, essentially. Okay, so for all the efforts that they put in, all right, they were able to do less work than they were over here. All right, now if you look at something else, like sometimes, you want to substantiate your argument. So if we just look at something else like, let's see, an RSI. Okay, so we'll go to the RSI, so relative strength index. So this is the change in prices. Price candle closes upward versus downward, all right, to identify momentum. So we'll look at the RSI on the 4-hour. This was pretty cooked. All right, so we are in overbought territory. The last time we were there was this candle over here. Covered way more distance with this one, and we were already in overbought territory over here. If we look at something like CCI, which is another indicator that's useful. So CCI is a commodity channel index. It's simple. It's another momentum indicator, but it's a little bit more sensitive. But if you want to use this, if you want some of these more sensitive readings, I would suggest using this. So this is cooked, absolutely cooked on the 4-hour. The last time we saw it this high was all the way back when we had our breakout in April. All right, so for the amount of movement that we've had, it wasn't really warranted that the reading is that high. So that is another piece of evidence. And then the last thing I would say, which is something that has always been useful, the premium shifted over here. We actually were trading at a premium relation to spot. So for the majority of this range, okay, the futures were trading at a discount. Okay, so the perps were trading at a discount, meaning that spot price, there was a positive basis, or spot price was above the derivatives contracts. So, and then I'm just talking about the perpetual swaps, not the term structure. So, or rather, not the forward months. So just the perpetual swaps. So what we saw is, again, okay, not just the funding shifting, but that basis. All right. So in terms of spot price shifting from being above the derivatives price to being back below the derivatives price. So all these things adding up. Okay, longs piling on, doing less work. The crowded side of the market at that point is clearly long. And when the derivatives contracts are showing that there is that negative basis, or rather that the derivatives are above the spot price, that just says to me that more on the derivatives exchange are piling on with higher leverage, and then you have the potential for trap traders. And what do trap traders look like? Well, if we look at this chart, for example, so we'll zoom in, and right above this monthly level. So if we just go to something like, well, you can see it right here. So above the monthly, all right, we'll take this off. Most of the volume is transacted, okay, where the dark blue is. So what you'll see is above this monthly open, okay, a lot of dark blue, okay, dark blue, and aggressive selling right here, okay, aggressive buying right at this area. That's likely a liquidation. But if we turn on the delta profile, and this will probably show us that most of this is a positive delta, right? So right above these highs, positive delta. If we look at something like the daily, and positive delta above the monthly high, to me, what that says, all right, being that if we're looking at this on the daily right now, I would look at the monthly open, for example, that key area where many were likely basing stops around or basing breakout longs around. Okay, what we saw is that there was a lot of buying above this area. Most of the volume was transacted above this area, so the monthly open being this high right over here. Again, an area that I said was very important. If we just get rid of all this stuff now and put this back on, monthly open right there. All right, what you'll see is there was a ton of volume that took place right above this high. So a ton of volume that took place right above that high, so monthly open. Ton of volume. All right, it's blue right now because there's a positive delta. So on the right side, that's the volume at the ask, all right, or at the offer. So if you're looking at the order book, the top portion of it, right? So if you're using a market order, that's where you're hitting. A ton of positive delta, so much more buying activity up here, right above that high, probably anticipating that if this high broke, it would be in a continuation upward. And then this sets up, as I mentioned, another thing that you should look for is that trap traders, rather those trap traders. So you could imagine that all this volume that took place up here, when price began to reverse, all right, these traders were trapped. And what do trap traders have to do? Well, essentially their feet are held to the fire. And what we'll see is that, this next candle down occurred rather violently, and these traders are forced to close out, and you get these massive moves to the downside. In this case, it's not massive, but the idea is still the same. When you're forcing these people into an uncomfortable position, they all have to go for the door at the same time. So this is what I constantly pay attention to. This is the most, what in my opinion is the most useful information to pay attention to, the most pertinent information. Okay, who moves the market? Buyers and sellers, right? So the market moves upward by people taking liquidity, okay? People aggressively buying. The market moves downward the same way, okay? Limit orders just provide friction, all right? So when there's a lot of limit orders, when there's a lot of liquidity, there's a lot of friction. So you have to take this into account because if you have less liquidity, you can move the price more with less volume. But all else being equal, when we have, all right, a lot of aggressive buyers, okay, and prices moving less, all right, who's stronger in that case then? Well, the limit order is stronger, all right? And your larger traders are going to be using limit orders because it allows them to put positions on passively. And from a transaction cost standpoint, it's a more economical decision. Rather, it is the more economical decision. It is the more, in terms of protecting yourself against any type of transaction-related costs, or rather mitigating for them. This is the sounder thing to do if you're putting on a larger position, either selling or buying, right? Unless you're trying to provoke the market, in which case you just hit the bid or hit the ask with a large order. So that's that, guys. All right, this is something that I have always pointed out, and it's been pretty spot on. And this is why I think that more traders need to be paying attention to order flow and learning how to use these tools, because these are the tools that you're using in other markets. All right, when I came to crypto, what I observed was, in the beginning, I used to raise my voice about it. It was very basic TA used, and it's great because there's a lot of use for it. Price action traders come to crypto, they do really well, and they don't really pay attention to volume because in Forex, there's so much turnover anyway. There's no emphasis really on volume. Unless you're paying attention, major shifts, major fundamental shifts, catalysts, and so forth. But leaving out volume leaves out the most important thing, right? We're talking about something that's being transacted. I want to know at levels, okay, at highs and lows, for example, how many people are selling, rather, or how aggressive is the selling, right? At the lows, I want to know, are buyers actually aggressively stepping in at the support, right? These are all things you can only tell if you're paying attention to order flow. So if you're interested in learning more about this is why I suggest signing up for Blockroots. Okay, we're not a signal provider. We are truly educational service, and my experience in markets, all right, Josh's experience in crypto, it's really a perfect marriage of the two sides, and this is primarily what we focus on. So everybody, happy holidays. As always, it's been a pleasure. This is Ryan with Blockroots. Exercise proper risk management and trade effectively.